Okay, so now let's try to understand about cash and cash equivalents. And before understanding the textbook concept, let's go through some real world examples. So what happens is, like, whatever money you are having in terms of cash or money in the bank, that is treated as your cash. Now, but except that there are certain items to whom we call as cash equivalents. They may include checking or demand deposits. Just like Microsoft, if you see as a company, they have a general bank account, and within that bank account, what happens, they keep certain money for their daily cash or cash expenses, which they keep on requiring for paying to vendors or utilities or rental, etc. So that is classified as a cash, or we call it general cash. Except that there may be some money market funds. It is like, if you see the company Cisco Systems, so that holds billions of its treasury portfolio, much of which is placed in the highly liquid US government market funds. So what happens is, like, yeah, US government money market funds are there where you put your money, and if you want that money, you can quickly get that money by selling those funds which you are holding. So Cisco company is holding that, and whenever they need that money, that can be quickly converted into cash. So that we call as cash equivalent, because immediately the cash can be received from that. If you see the third example of commercial paper which are having maturities of less than 90 days, so it's like, when your company buys a 30 days unsecured loan issued by a highly rated company like General Electric to finance its short term receivable, we call it as cash equivalents. So basically what happens is, like, your company is buying a unsecured note issued by a highly rated company. So what happens, the companies like General Electric issues the commercial paper, and other companies buys those commercial paper. So when you have bought that commercial paper, you are not having money in your bank account, but you are having commercial paper as a document in your bank account. And if you go to the company who issued that commercial paper, you will be getting the cash against that commercial paper. So you will be simply calling that you are having certain cash equivalent, which can be known as commercial paper as well. If we go ahead, we can see that there are some treasury bills also whose maturity is less than 90 days. Now, the Apple Incorporation company invests a portfolio of its massive cash reserves in newly issued 4-week or 13-week US treasury bills, because they are considered the safest and the most liquid investment in the world. Now, Apple, you know that they keep on selling their phones in cash, or I can say money in the bank. Now they have very massive cash in their bank account, and what they do with that cash, they deposit that with the US treasury bills. So these are, I can say, treasury bonds or bills kind of investment, where the money is treated as safest, and if the Apple company wants the money within 2 or 3 days, they can get that money very quickly basis. So the treasury bills are also treated as cash equivalent. So right now you might be understanding that the cash equivalent is like the other items except cash which can be converted to cash very quickly. If we go ahead and see some compensating balances which are not legally restricted. So let's suppose there is a small manufacturing company, and that company is having 50,000 minimum balance requirement on its loan with Wells Fargo, but there is no legally binding contract preventing withdrawal. So it's like, many a times whenever you are investing money, and your bank might also be requiring that there should be some minimum balance, but there is no restriction that after depositing that minimum balance you can't withdraw that. That is required only for opening the bank account. So in that case, the money is not legally restricted, you can withdraw that. In that case as well, you call that number as compensating balances, and that is treated as the cash. Why? Because the full balance is listed as cash with the restriction disclosed in the footnotes. So in these cases what happens, company while preparing their annual report, they write it as like cash, but they also write a footnote below their documentation, and they say that okay, there is certain restrictions initially, but we can withdraw it. If we can see some compensating balance, but there are certain legal restrictions. So there may be a construction company has a loan from PNC Bank that legally requires us to maintain a reserve account of $100,000. The legal agreement prohibits the withdrawal. So this happens generally in the case of construction companies, wherein the builders needs to keep certain money with the bank. Now if they need to keep that money $100,000 with the bank, so it cannot be treated as a cash equivalent. Why? Because that money cannot be converted to cash on a very quickly basis. So what do you call that? You call that as non-current asset, or you say that as a restricted cash. In the current section, if the loan is a short term but not cash or cash equivalents, they are not cash or cash equivalents. And similarly, if we see, there are certain items whom we call it certificate of deposits. So the certificate of deposits having maturity of less than 90 days. So it may be like Starbucks buys a 90-day certificate of deposit from a regional bank to get a higher yield on fund. It knows that it won't need for 3 months. So what happens, the company is having certain money within their bank account, and they know that for 3 months there will be not a very good season, people won't be buying much coffee. So in that case, what will happen, they go and buy a 90-day certificate of deposit. They call that instrument or document as certificate of deposit, and they get certain interest on it, or I can say discounted price they get on certificate of deposit. So basically they are yielding higher return, and after 90 days they can get the money. So definitely this is also a cash equivalent which can be converted to cash very quickly. So these are some of the examples of cash and cash equivalents which we saw right now. After that, let's see the textbook definition about these cash and cash equivalents. So what the textbook says. So whatever we discussed about, that is in the text form we will be discussing. So basically the cash is the ready money which you need, and now the cash includes anything immediately available for spending or depositing. That is what you all know. There may be physical funds, just like we have our coins and currencies in our bank, or there may be petty cash. Petty cash is like small amounts which are kept as cash for certain minor expenses, just like if you keep on buying office supplies, office stationery, etc. So that is also treated as a cash. If you go ahead, there are items known as the bank deposits or demand deposits. These are the funds available for immediate withdrawal without prior notice or penalty, because you have deposited certain money in the bank, and from the bank you can just go and withdraw the money. So there are checking accounts, your main corporate bank account for paying the bills and receiving revenue. Whatever you are selling, you are getting the money in your bank account, and whatever you are paying the bills from that. So there may be some checking account, or some people call it as a current account instead of checking account. If we go ahead, there is a savings bank account as well, which is known as funds held at bank to earn interest, but which can still be accessed right away. So these are generally examples of money which can be quickly accessed. Now there are other items just like negotiable instrument, yet not deposited. So if you haven't deposited some negotiable instrument, which is like payment received that are waiting to be cashed or deposited, just like customer checks, money orders, or cashier's check. You receive the money order but you haven't deposited that into the bank, or you receive the cashier's check but you haven't deposited that into the bank. So that is also treated as cash, because immediately you can get the money out of that. And there are certain unrestricted compensating balances as well. When I say unrestricted compensating balance, which we saw here, unrestricted compensating balances, where there is no restriction on the money. This is the minimum amount you must keep in a bank account as a part of loan agreement. So initially you need to keep that money, but you are not legally forbidden from withdrawing it, but later you can definitely withdraw it. If you can technically take it out, you can take it out from the bank, it is counted as cash. If legally it is restricted, it is called as a restricted cash. What we saw here, that was called as a restricted cash here, and we call it as a non-current asset. And now let's go and quickly see about the cash equivalents. So basically the cash equivalents are the highly liquid investments. Highly liquid meaning you need to get very quick money or cash out of them, which may be like readily convertible, and there is insignificant risk, which we saw in all of the above cases. There is a short maturity, that the investment matured 90 days or less. If that can be converted to cash, we call it as a cash equivalent. There are short-term government debts, just like treasury bills, which we saw above, which are issued by the government, or there are short-term corporate debts, which is like one corporate issuing the corporate debt to another debt. In terms of commercial paper, one company issues that to another company. There may be some bank instruments and funds, just like certificate of deposits. So these are the time deposits held at bank only if the original maturity date was 90 days or less. So time deposits with the bank you can do. And there are certain money market funds as well, just like mutual fund that invest exclusively in highly secured short-term debt instruments like treasury bills and commercial paper. So there are some money market instruments as well which can be encashed within 90 days. So these are some of the examples of cash and cash equivalents.